like it. Uh, so, like Ketul said, I'll focus a few slides on the macro events that are happening. And of course, when you say macro, there's nothing more bigger than Venezuela, which is dominating people's minds at the moment. But I think that's precisely the reason to address it first off. Because while politically it occupies a large spectrum in terms of what Trump is trying to do, is Venezuela move against narco, or is it against the oil, or is it against China? These things will be debated. But the key thing is that while Venezuelan resources are very huge, and that's the slides going around where they say that they have the largest resources in the world, the fact is that less than 1% or 1 million barrels a day of crude are actually coming out of Venezuela. This is partly due to the sanctions and partly due to the fact that since nationalization, the corrupt Venezuelan whole administration has effectively destroyed their capacity to do. So reports you would have read today that Mr. Trump has asked the US companies to invest $100 billion to revive the Venezuelan oil. Now, clearly those companies haven't jumped with joy at this. They've all been dragging their feet. I think Chevron is the only one which has a current operation there, and it will continue. So I think that the key thing to remember is this: just one more geopolitical event which the market will absorb. So unless the US gets into a direct war, not a trade war with China on this, right? Of course, China acting on Taiwan as a result of this, but knowing China, they are very, very long-term and strategic in whatever they do. They don't do a knee-jerk reaction that Trump attacks Venezuela, we attack Taiwan. But definitely, that's the only thing to watch out for where this is going to escalate into a physical war. The trade war has been continuing and will continue. So to sum it up, I think Venezuela is not going to make a big difference to the markets. Even oil prices, you saw how they have behaved. They have not really reacted strongly to this whole move. So can we move to the next slide? Yeah. And now we come to the other issue in terms of the inflation and the Fed funds rate. Right, the Fed has been on a cutting spree as inflation has generally eased, and it's belied the expectations that the tariff would cause a sharp spike. In fact, the Fed chair himself has said he expected it as a one-off spike rather than as a sustained higher level of inflation. This is what made them turn a bit dovish in terms of the cut. Though, obviously, they are not matched with Trump's requirement or request, whichever you put it, of rate cuts. And hence, you are going to see a new chair. And in the next slide, you will see that as far as the rates are concerned, right, the forward inflation expectation is more important than the current inflation. And I think there what you do is the Treasury, they have this inflation protected bills, right, which they issue. So the difference between the two gives you a sense of the future inflation. And that has been declining, as you can see from the graph, and it's currently at about 2.3%. And worldwide also, this whole thing is supportive. And the Trump, and if you in the last Fed meeting, they said that they're going to stop the QT and restart some kind of a QE. So clearly, liquidity and rates are generally expected to be positive in terms of the equity markets like these kind of events. So in the next slide, however, we are showing you that the Jan 28 meeting, because of the fact, and you'll see that in a subsequent slide, the labor market seems to have bottomed out, is that there's unlikely, and it's an 85% probability that there won't be a rate cut, it will be on hold, right? Now, this is partly because maybe Mr. Powell doesn't want to take a stance towards the end of his term, because the next Fed chair will be starting May 15th. So March meeting is the last one that probably Mr. Powell will chair, and market will start looking at that. So effectively, at this point in time, they are saying that there's no rate cut likely in January. That's the current state of affairs. Of course, US is heavily data dependent, and all the data points that keep coming out will be discussed, and this probability will go up and down, and just important to keep note of it. But definitely what this is telling you is that May 15 onwards, Mr. Trump is definitely going to choose a nominee who's going to listen to him and seek excuses to do a rate cut. So the medium-term projection is still for a rate cut scenario to prevail over 2026, 2027, right? So in the next slide, right, there is another thing in terms of the National Financial Conditions Index, NFCI. So what this is a summary of all the things that are there, the data points in the US to arrive at it, and a negative value of the NFCI. It tells you that the financial conditions are looser than their average. and looser financial conditions naturally support economic growth. So, but remember that when this implies a rate cut, Fed rate cuts take 6 to 9 months to actually get an impact on the economy. So what you're seeing in the economy today is what happened 6 to 9 months ago. So if the conditions are set to loosen further, you can expect that running into 2027 too, the economic activity should get a boost and a support from the loosening financial conditions, and with a new chair supporting it with the rate cut and liquidity infusions. Right. The next slide is that I mentioned this briefly about the labor market. It seems to have reached a trough. So you take the 4-week moving average of weekly jobless claims, it hits its lowest level since April 2024 at 2 lakh roughly. So this is a sign that perhaps the jobless claims could have peaked in December. So that's just a point to note. Obviously, we have to look at monthly data points to draw the chart, but at least from a technical perspective of the moving averages, it seems to have hit a trough. So this is an important thing, because in the US, I mean, just to point here, in India, we keep focusing on growth versus inflation, right? And the third element that comes into India is currency. But in the US, while this growth inflation trade-off is the key thing, is the labor situation, which is the other key significant driver of decisions. So the three factors are growth, inflation, and labor. So the US, that unemployment index is a key one to track. Next slide, can we move to, right? Now we come to another predictive, historically predictive, called the 2-10 spread, right? This is an indication, this is the difference between the 2-year treasury and the 10-year treasury, right? And so if you see in 2022 to 24, post the COVID period, this was in an inverted status, right? So what does the inverted status mean? That the 10-year was lower than the 2-year. When does it do? When the future outlook is very bleak and nobody wants to go and borrow at the 10-year. There's no demand for that paper. Now that inversion has happened and now this is rising. So what this is actually telling you is that the longer dated paper is, as its textbook theory says, should be costlier than shorter dated paper. So that means that in the future, there is a demand for 10-year money. There's this segmentation theory of interest rates, which says that each bucket behaves as per the demand and supply at that bucket. So what this is telling you now is that people are now confident about the future economic growth. Hence, they're willing to borrow 10-year money or invest 10-year money. Either way you look at it, to go that. So it's a good sign that future economic recovery is continuing to improve. So this is an important thing that worldwide analysts track, known as the 2-10 spread. On the next slide, it comes to the, now I was also wondering what Ketul had put in terms of, I know what is being said here, but the OBBBA is nothing but one big, beautiful bill act. Okay, it's Trump's way of giving money back to his tax base who supported him in the election, you can say. So if you see the tax refunds that they're going to get are going to jump up, right? And naturally, when money comes in the hands of people, America is a spending economy. People love to spend whatever money they get. So I think that that's a good sign from the fact that consumer discretionary spending will likely to increase. And there's a probability, if you look at it, when will they get these checks, is that before August 2026, most likely. So which means that you, with new chair coming in May, and the possibility of rate cut, subject of course to the labor market and the inflation conditions supporting, you're going to see both a scenario of better liquidity, rate cuts, as well as Americans getting money in their bank accounts, all of which point to a very supportive conditions for the US economy to grow and not get into a stagflationary scenario, which was being talked about a few months ago. So I think on that note, saying that by and large, just to summarize what I'm saying, is that Venezuela is not going to be a big event shaking the markets. No rate cuts likely in January. The US situations of labor market conditions and all are supportive, and the big beautiful bill are supportive of an economic recovery, at the same time supported by a liquidity and a rate cut scenario over 26 and 27. So I think that summarizes it from a macro perspective. I'll now excuse myself and I'll hand the floor over to Ketul to continue this. Any questions on what I have said also, I think Ketul will be happy to answer this at the end of the webinar. Thank you to all.
Hi, Sunil. Thank you very much for the time today. Sunil has another appointment today later, so he has to rush to it, and he won't be able to take the questions. But I'm here, and at the end of the webinar, we'll be more than happy to take any questions. Thank you, Sunil, very much.
Right. Thanks a lot. Thank you.
So everybody, yes, if you have any questions, please go ahead and put them in the question Q&A box of the part of the webinar. At the end of the webinar, we will have all those questions answered. Even if it is something not related to the slides that we are talking, feel free to ask them. This is a webinar for our current clients, potential clients. So if you have any question on the existing portfolio, macroeconomics, we are more than happy to answer all of those questions. Now, moving on to the next slide. So this is one of the most pertinent questions that we have received. So we thought today in the webinar, we will focus only on the two main parts, which most of the time, this is 99% of the questions that we receive in our meetings. That is AI in a bubble, and should we invest in the US stock markets in the current scenario? So these two questions, we thought that it overshadows everything else. No matter how good the portfolio is, or no matter what we say about the portfolio or stocks, this question is always there in the back of the minds of our investors. And so whatever we say doesn't potentially go through, and people are not willing to listen. So we said, today we will focus exclusively on these two questions, and we'll get into the depth of it as much as you want. If you have any questions, we'll get into more depth. But let's start with the first point is AI in a bubble? A large part of the US portfolio that we have is exposed to the AI theme. And it's about 30 to 40% of our portfolio right now. So it's very important for you to understand that AI is not in a bubble. When people talk about a bubble or overvaluation, they are talking about 15 to 20 stocks, literally 20 stocks that you can pinpoint in the market that are overvalued. Out of those 20 overvaluation, 10 of them could be in a bubble. So, for example, take Palantir. It trades at more than 100 times sales. So there you can say, yes, it is overvalued. You could call it's in a bubble territory, but there aren't many such stocks, especially in our universe that we cover. We don't cover the small and micro caps or mid caps. We don't care about them. We primarily invest in large caps. So if you look at the large cap universe, there aren't many such stocks. And we will go through the valuation metrics for the entire sector as well as a few individual stocks to show you why those 20 stocks that the media talks about are overvalued and could be in a bubble territory. But the other hundreds or thousands of stocks that we follow and invest in, they are nowhere close to a bubble territory, and we should happily invest in them. So that's what we'll discuss in the valuation part. The second part we'll discuss is the massive cash flows you are seeing from these large caps. So typically when you have such massive cash flows, bubbles do not happen, because cash flow is a very strong fundamental factor that supports the stock prices. So you cannot call it a bubble. We'll do some comparison with the dot-com era and how it is incorrect, and why capex is not a concern for these businesses. So let's go through that one at a time and address them head on. So yeah, so this is the first one where we are trying to see if this is the whole sector is in a bubble, and we are trying to compare it to some bubble time valuation metrics from the tech bubble in the year 2000. At the bottom on the right hand side, you will see, and the purple column is the one which is the valuation related metric, which is PE ratios, 24-month forward PE ratio. So if you will see, currently the PE ratios are all in the 20s and 30s range, right? So 20s and 30s range for an aggregate of 23.9. So I say, let's say round it off to 24. It is nowhere close to the aggregate PE ratio in the bubble era, which was 52. So close to double. And individually, you see some of them are above 100. They were above 50, 60 PE ratios. Whereas currently, they're all in the 20s range. So we are it's far away from a bubble. These stocks need to at least double or triple over the next few years to get into bubble territory without the earnings increasing. So always remember, PE ratio is a ratio of price and earnings. If earnings increase, then this PE ratio will not increase. So without any further earnings increases, the stock prices have to double at least to get to bubble territory of the year 2000, which so far doesn't seem to be the case. So we firmly believe from a valuation perspective, these stocks are nowhere close to a bubble territory. Another important indicator, Berkshire Hathaway bought about $5 billion worth of Google shares in the last 3 to 4 months. So, and this was a new position. This was not a position that they held like 5 years back or 3 years back, and they just added to it. No. Berkshire Hathaway, as we all know it, it is Warren Buffett's investment company, and they initiated a new position in Google with a total investment of about $5 billion. And they are a value investor, and they are not pressured by anybody. They really don't care about what AI is doing or what the world is doing. They focus very much on the valuation of a company. So when they are investing, one of the marquee value investors in the world is putting 5 billion of their money in a company which is at the top of the AI table. For people talking about AI bubble and all that, it clearly says that the entire sector is not in bubble territory. So definitely we do feel that a lot of these stocks are very much worth investing, and we continue to invest in all of these stocks. Moreover, why this is happening is because AI, when it started, it was considered as a single sector because there were probably 30 stocks or 40 stocks that were benefiting from the AI theme. Now there are hundreds of stocks that are benefiting. So now you can differentiate between the semiconductor players to semiconductor manufacturers to chip designers to software players to middleware, all the way to consumer applications. So the entire ecosystem is now well developed, and you can differentiate between different players within the AI ecosystem. And that's why when we say 20 of those stocks, that means some parts of that ecosystem are overvalued, but the rest of them are not overvalued. So we typically, when we see this, we move away from the overvalued part of the ecosystem to the undervalued part of the ecosystem. So some semiconductor stocks, maybe they are overvalued, but and that doesn't include Nvidia, by the way. As you can see in this chart, in the top, the third stock from the top is Nvidia, and it's trading at only 24 times PE multiple. And so that's why Nvidia, even though it's a semiconductor stock and it's one of the largest ones in the AI space, in fact, largest in the world, it is not in the bubble territory from a valuation perspective. So we are pretty happy with that. There's no issue with Nvidia per se. And so this further goes on to say that within AI, there are pockets that are expensive, there are pockets that are cheaper. The whole space is not expensive. So we cannot stress enough that you should not be worried about a AI bubble or a valuation bubble in the AI space. If you are worried about it right now, you will probably miss the next 2 or 3 years of gains and stock returns, which we are expecting based on their current valuations and current earnings. So don't worry about the AI bubble from a valuation perspective. Absolutely nothing to worry about it. Moving on to the next slide. Stock bubbles don't look cash rich. What we are trying to say over here is what is the cash position of these top AI stocks, the ones that we discussed in the previous slide. You will see starting from $102 billion of a cash position on their balance sheet. This is net of any debt. To $41 billion at the lower end, which is with Tesla. So if you have such huge cash positions, you are not even talking about leverage at this point. There is a long pathway for you to use this cash. And plus, they generate similar amounts of cash. Each one of these companies, they generate 75 to $80 billion of cash every year. So when we moved from December to Jan of 2026, for all of these companies, they added another, let's say, 70 to $80 billion of cash last year in 2025. So when they are spending cash, it doesn't matter a whole lot because they are generating it at such a fast pace too. So these cash positions are a further buffer that even though they are doing capex, it does not hurt them at all in terms of their cash position from a balance sheet perspective. So when you have such huge cash positions, it is highly unlikely that you can call them in a bubble territory. Typically, in a bubble era, it is exactly the opposite. Companies are over-levered, stock prices are massively overvalued, and when you are over-levered, even a small mistake or a small change in the macroeconomic conditions causes the stock prices to crash significantly, and that is what is the definition of a bubble. Right now, we are in the exact reverse position where the valuations are decent, as we discussed in the last slide, and these companies have massive cash positions. So then getting into trouble over the next 1 or 2 years, is the probability of that happening is fairly low. Let's move on to the next slide. So even then, we do get questions about comparison with the dot-com boom for between the AI stocks and the stock hit, and uh, the characteristics of the dot-com boom. So the middle column actually in the table you see is the characteristics of the dot-com boom from the early 2000s. And then the second, the last one, the third column that you see on the right-hand side in that chart is the characteristics of the current AI related companies. So the first part, the technology, let's get it out of the way. The dot-com boom was all about fiber optics, the physical connection that provides internet access to everybody in America as well as the rest of the world. And there was a massive overbuild in it. We knew companies like Level 3, WorldCom, these companies went bust because they overbuilt massively, expecting the demand to come. Their utilization rate, as you can see from the third row from the top, was 7% in those days. So 7% is a fairly low utilization rate. So there was massive overbuilt and overcapacity that was being built in the dot-com era by those companies. Today, that is not the scenario. We are still hardware constrained. Today, if I want to go ahead and order an NVIDIA GPU, there is a 3-month waiting list. That does not say that there is an oversupply. Actually, there is a bottleneck right now. There is no question of oversupply. The utilization rates are 80% plus for all the hardware. And that includes hardware that was bought 5 years back also, which may not be used so much because they are now mostly not that useful because they are older hardware. So even then, for the entire industry, the utilization is above 80%, which does not get even close to the 7% utilization rate that we saw in the early 2000s. And so that's why, from a capacity, demand, supply perspective, there is no comparison between the dot-com boom and the current AI boom that we are seeing. We are far away from that. Maybe overcapacity and overbuilding will happen 3 to 4 years into the future, but right now we are not even close to that, right? And so I think that debunks another myth. So first we discussed valuation. The second we discussed cash positions. Third, we are talking about demand and supply. None of these actually support any worries about a AI bubble or any issues in the AI space. That brings us to another question, which is margins and the capex that they are doing. So anytime a company is spending on either on R&D or on infrastructure, you have to be worried. Are they generating margins out of that, or this spend is going to be useless and they are not going to generate margins and earnings out of that? So if you see the chart below, this is the cloud segment of Google. This is not entire Google, just the cloud segment, which is the AI infrastructure segment of Google. This segment, their margin from the first quarter when AI was introduced, that was March of 31. At that time, for Google's AI cloud infrastructure segment, their EBIT margins were 2.6%. Right now, they are 23.7% in the September quarter. So you can imagine what a huge jump they have had. They have had almost a 20 percentage point jump in margins. So now, if you are running this company, would you like to spend more on such business where your margins are growing day and night? Absolutely, yes. And that's what they're doing. So when Google says that they are spending on AI, or when Microsoft for the same business, Microsoft's that segment margins are 43%. So you can imagine Google is at 23.7%. They still have the possibility of going all the way to 43%. Everybody doesn't maintain the same margin. So Google could get to 40, Google could get to 50. We don't know that. But the trend is clear that it is expected to grow. And we already have examples where Microsoft similar business is doing 43% EBIT margins. When you are doing such EBIT margins, there is no chance, practically zero chance of a bubble, because these are huge revenues. So you are not talking about revenues of a few 100 crores or 1,000 crores where you are making such huge margins. These margins are on a revenue of 80 billion that we are expecting for that segment for Google for CY26. So on an 80 billion, EBIT margins being close to 23% means you are generating about $19 billion worth of cash from that business alone on an annual basis. So this doesn't worry us at all. In fact, we are quite bullish on a lot of these stocks in this sector because of such massive cash margins, EBIT margins, and the growth of that. If it were a bubble, you would see the exact opposite. This chart would be 23% when it started, and by now it should go down to 2-3%. Then it could be a bubble. This is the exact opposite. So that's why we are saying that we are not even close to a bubble, because the things that we are seeing are the exact opposite of a bubble, not even leading to a bubble. So from a fundamentals perspective, we don't believe a lot of these companies are anywhere close to a bubble. Again, margins are increasing and increasing massively. That is not a sign of a bubble. So I think this ends our discussion about whether AI is in a bubble or not. Now we'll move on to the general US economy part, where that's another question, and that's a very pertinent question. We continuously get this question: if the US economy is in a bubble or not, right? Or if it is worth investing in the US economy right now at this point in time. So a few things, I think bare thesis you have already heard a lot, so we'll not go a lot into the details. But yes, Trump is unpredictable. He does things randomly. So he's put tariffs randomly on countries. He has had a regime change in Venezuela. So all these things are negative. Absolutely, they are negative for the economy. But to what extent? It may be negative to a certain extent, but that doesn't change the bull thesis if it's not going to impact the markets much. So I think what happened in Venezuela is a blip. There's nothing to worry about that over there. Some things keep on happening. These are big economies. You are talking about the world stage, and they don't impact the markets as much, because those economies like Venezuela, they are not a major GDP contributor. They are not a major revenue contributor. And they are not a major oil supplier either, as we saw from the first slide. They do have reserves, which means it's in the ground. But in the ground and bringing it outside, making it usable, you have to go through drilling, you need refineries. It's a long process. It's going to take a lot of time. So those are smaller issues which generally for investors, it takes them off the main important parts of the investment thesis. And that is just noise. What we want to say is that don't worry about them. That is just pure noise. On the bull thesis, why we feel this is a good time to invest in the US is, we'll discuss through a few points over here. As Sunil earlier in the session, he mentioned that we are in a monetary stimulus environment right now, where the Federal Reserve, US Federal Reserve, is cutting interest rates. Historically, there has never been a single instance. You see all the green bars over there. Those are the instances where US Federal Reserve cut interest rates, and the US was in a non-recessionary phase. US is not in a recession. US GDP growth last year and next year is expected to be 1.9%. So when the Fed cuts interest rate in a non-recessionary era, the next 12-month returns for the stock markets have always been positive. There is not a single instance, if you go all the way back to 1974, where the Fed started cutting interest rates and the 12-month forward returns were negative. So that gives us a lot of confidence that the chances of a negative returns when the Fed is cutting interest rates are pretty low. So we should not be worried about that. So that's the central bank part. The other important part is the fiscal stimulus, the One Big Beautiful Act, OBBA, that we discussed in the earlier slides. So One Big Beautiful Act does give a tax cuts to individuals, but it also gives massive tax cuts to the corporates. So you will see that a company like Google generally generates about $75 billion of cash annually. From the first year of the tax cuts from OBBA, which now will come into play in the first quarter, second quarter, third quarter of 2026, is they'll generate an additional 25 to $30 billion of additional cash flows. So 1/3 of Google's last year's cash flow, they are just going to get from the tax cut. And so that's a huge boost to corporate margins, to corporate earnings, and corporate spend, because when Google gets an additional $25 billion, they'll definitely spend it on AI infrastructure, they'll spend it on chips, they'll spend it on R&D, lots of other, and similarly every other company will do that. It's not only Google. All the tax cut is applicable to the entire US corporate sector, and so everybody is going to benefit of that. So two factors so far we discussed. One is the central bank is cutting interest rates, which is very bullish for the stock market. Second is the government is cutting taxes, which is also bullish for the markets. And then again, we just go to the general market valuation. It is maybe 10-15% above the historical 5 and 10-year averages that you see in the chart over here on the left-hand side. So if you are 10-15% above historical valuations, and when you have such massive tailwinds, which is bullish for the stock market, one should not be worried about valuations for now. So from a valuation perspective, we are quite okay for the entire S&P 500. Moving on to some comparisons. This is one slide which is very important, because I think people miss the part that if you are worried about smaller things like Venezuela, you will miss these returns by not investing in these markets, right? So we did a comparison about with Nifty, which is the blue line that you see over there, and versus the S&P 500, which is the orange line that you see over there. So the returns over there you will see are more than double. If you take a last 15-year history, we are not talking about 1 to 5 year. The returns for the S&P 500 have been more than double of the Nifty. So what are some of the reasons for that? Because we certainly know that US GDP growth historically and also in the future is generally in the 2 to 3% range, versus India grows at the 5 to 6% range. So why is it that the US stock markets keeps outperforming the Indian stock markets, and not over 1 to 5 year period, even over a 15-year period? And you can go back further, you will still see the outperformance. The point being here is there is massive outperformance. So what is the reason? One big reason is that US companies have global revenues. Only on the right-hand side chart, you will see only 52.2% of US S&P 500 index revenues come from the US. So roughly half comes from the US, and about half of their revenues comes from outside of the US, which means they generate revenues when China grows, when Africa grows, when India grows. All of these regions, they have sales in. We use global products. We use Microsoft, we use Google, we use Apple, right? We use NVIDIA chips, we use Intel chips. All of these companies, they grow from growth outside of the US also. And that is why they are not just dependent only on US growth for their earnings growth. Consequently, the earnings of US companies grow much faster than the US GDP growth, historically also and in the future also. And that is the reason we believe that the US stock markets outperforms other indices as well as the Indian stock market, even though the US economy has a lower GDP growth. Secondly, corporate governance, management, and capital allocation are top notch. We have never seen such phenomenal corporate governance, neat and clean management teams, as well as capital allocation anywhere around the world. These are some of the best teams that are working for you. So, totally from that perspective, non-corrupt, very motivated with the right incentives. You have perfect combination of a good ecosystem, global growth, global sales, and management that is aligned with minority shareholders. That provides the perfect nurturing ground for companies to provide extraordinary returns from the stock price perspective. So I think that's another reason why we do feel that these companies and these stocks outperform their global or other non-US peers. The last but not the least, and this is the most important part for you to understand in this entire presentation. If there is one thing that you want to understand in this entire presentation, is this idea that US companies grow without capex, and that brings phenomenal earnings to these companies. So let me give you an example. Since we are all based out of India, let's take an Indian example, right? Say a company like Maruti, if they want to double their revenues, they have to double their production. To double their production, if they have one factory that is building cars, they have to build another factory to build double number of cars. Consequently, they have to invest. If the first factory cost them $1 billion, the next factory that they're going to build is probably going to cost them more than $1 billion. Let's assume it costs the same. So if you have $1 billion invested in a factory, which you are running for the last 10 years or 20 years, now you have to build another factory, which requires capex. For this, you have to either go to the banks and borrow and then pay them interest, or you have to deduct it from your cash flows, which means that cash flow that was supposed to go back to the shareholders is now put in the ground for building a new factory. And this is the problem with all emerging market economies, where these are cash guzzlers. You will never hear about an emerging market company giving money back to the shareholders in terms of either large dividends or share buybacks. None of that happens. They are constant seekers of capital. They come for a secondary issue and they come up with lots of IPOs. They always want more and more capital. It is because of this feature of emerging markets where you need massive amounts of capex to be done for any growth. Versus now, contrast that with companies in the IP space, whose earnings and growth come from their intellectual property, not from building another plant. Easy example, which everybody understands, Google. When Google introduces their services into a new country, like say India, or in a new geography, or a new service altogether, now they do not have to double their plant and machinery. Basically, they don't have to, if they have one plant, they don't need to build another plant. And so any revenue they generate from that can directly go as either dividends, or it can go back to shareholders in the term of stock buybacks. And that's what these companies do. Most of these companies have 50, 70, $80 billion stock buyback programs every year, which means they're returning shareholder to the capital, as opposed to companies in emerging markets. They are always sucking capital from the shareholders and asking for more and more capital. And so because of that, they don't have to borrow from the banks. Most of these companies, they don't have any debt on their balance sheet. So they can easily return that capital to the stock shareholders, minority shareholders. And that's why the stock consequently performs much better than the GDP growth that you see in the US stock market. So if we find such companies at a reasonable valuation, that is the best way to invest. You rarely find such opportunities in the world where you get good management teams, a good ecosystem, everybody's incentives are aligned, and the returns from those investments are phenomenal because they are all IP related investments. This is some of the best and very fertile grounds for finding good return stocks. And that's why we strongly believe that these companies will continue to generate the returns that you see in this slide over here that they have generated over the last 15 years also. And so I think we are not too worried about anything else. Overall, it's a good time to invest. You have good companies, good returns, and so one should invest. So once you have agreed that one should invest, what are some of the sectors where one could invest? So we have provided a chart that typically which sectors do well in a post rate cut scenario for the next 12 months. And you will see at the bottom, there are averages, and the highest average returns you will see are mostly from the consumer discretionary space, obviously makes sense, from the technology space, from the industrial space also. Also, you'll see some good returns in the real estate space in a rate cut environment. So these are some of the sectors that one can focus on if they want to look at it from a broad sector perspective. We will not get into much detail. We have already discussed this, why we like these sectors. So we definitely like some of the sectors we like right now are mobile gaming, blockchain, quick commerce, telehealth, all these sectors. And there are some case studies from each one of these sectors, which will not go into the details. But if you have any questions, we are more than happy to address them in the Q&A part. So I'll pause over here for a moment. Suman, if you see any questions in the Q&A part, please go ahead and ask them.
Sure, sir. Thank you. So I'll start with the question. So there's one question regarding so which sector are most likely to be impacted by this trade war going on currently?
Okay. So trade wars, we have to look at it from how it is going to impact the consumer, because in a trade war, consumer is the first person to be impacted. And so it impacts the consumers to a certain extent. Now the exporters and the importers are taking a brunt of those tariffs away. And the third characteristic that is taking away the impact of the tariffs is the currency. So, for example, Indian currency has depreciated by roughly 7-8% against the US dollar in the last 6 months. So now if US was to put, as an example, 8% tariffs on US importing goods from India, then that 8% tariffs is already made up by the currency depreciation. So the cost to the US consumer in US dollar remains the same because the Indian currency has depreciated by 7-8%. A lot of countries are playing this game where they will let their currency depreciate against the US dollar. So the impact of the tariffs is nullified. So that's the first bucket, how the tariff impact is being nullified. The second is the importer who's importing stuff from outside the US. They can reduce their margins. So they are reducing their margins to the maximum possible extent till they don't get into negative cash flow situations. And they are taking the second impact of the tariffs. The third impact is now the importer will tell the exporter, hey, you reduce your prices, you reduce your margins. So everybody is going through this analysis where they are looking at how much price increases the consumers can afford and what the importer and exporter can absorb between them. So after all of that is done, currency, importer, exporter, and then comes the consumer. Now the price increases are passed on to the consumer, and that is where you see inflation. But we are not seeing meaningful upticks in inflation. US inflation is in the 2.7, 2.9% range. So that is not a big uptick in inflation compared to last year when there were no tariffs. And that is why we have a theory that a lot of the price increases are not being passed on to the consumers, the final consumers. Otherwise, you would have seen it in inflation, which we are not seeing it so far. So most of the tariff is increases are being absorbed by either the currency change or the importer or the exporter, which is the manufacturer of that product. So between these three, most of the tariff impact has been taken care. And that's why we feel inflation is not a big issue into 2026. And consequently, tariffs which have been introduced so far are not impacting the US consumer. And that's why we don't expect a lot of impact. But if there was any impact, the first one that would be impacted is consumer discretionary, which means travel, tourism, hotels, restaurants. All these sectors are the first ones which take the brunt of a reduction in consumer spend because that's the first one that goes under the hammer when a consumer is cutting expenses. So we have not seen it so far, but if we were to see, then you can expect all these sectors to have negative returns. Go ahead, next question.
Thank you. Another question we have received is currently, in your opinion, do you think that China could be a better investment opportunity compared to Europe or any other countries? Or are you looking forward to, diversify like more investments into any specific countries?
Yes, absolutely. So we are looking around the world. Our specialty is that we look only in investing in companies that are in the disruption and innovation space. So for the purpose of this, our investments, we define disruptive companies as the likes of, say, Tesla and BYD. They are disrupting a 100-year-old automobile industry. So we'll invest in them. That's the first bucket of our investments. The second bucket of our investments is the innovation related stocks. And as the name suggests, right now it comprises AI, blockchain, medtech, biotech, drones, uh, innovative pharmaceuticals. So all we invest in these sectors now, which means that we are not focusing on any country. We'll not say, okay, we want to invest in China, so we'll look at 200 stocks in China and invest one out of them. We'll not go and say, okay, we'll go to Europe, look at a list of 500 stocks, and we'll find the best available over there and invest in Europe. We are not a macro investor. We go from a bottom-up perspective. Are we able to find these innovative and disruptive stocks with good returns and good valuation? If we find them, then it doesn't matter where they are located, right? Because your returns are not dependent on where a company is located. Your returns are mostly dependent on the value you pay for that stock and the growth of that stock in the future. These are the two most important parts of a stock return evaluation, right? And so we are not going on a country basis and looking for stocks in that country or that region. Now, what we are finding right now are a lot of opportunities within the US. We have found some opportunities in Europe, some in Asia Pacific, some in Latin America. In 2024, we are also invested in a stock in China. And so, as and when we find opportunities, we are definitely going for it. But if we find better opportunities in a country, say more opportunities in US, just for the sake of going outside US, we will not go outside US. So that's our philosophy. We look for good stocks no matter where they are in the world. Right? Sumant, go ahead.
Another question we have received is so if anyone is a new investor to US market or let's say international equities, so looking at the past performance, the COVID, like before COVID, the stock market of US has performed really great. So do you also think that this can be a similar situation while going forward?
I think even it's not only just before COVID. I think even post-COVID, the US markets have continued to outperform. So it's not, and plus we are not saying that you should not invest in your home country wherever you live, right? Home country should always be 65% of your portfolio. You should put 35% of your exposure outside of your home country. That is the ideal way to invest. So no matter which country outperforms, you have a balanced portfolio. That's what we are trying to say. In this chart, we are showing how US has outperformed in the pre-COVID phase as well as in post-COVID phase also. It has certainly outperformed in either scenarios. And that is because of the fundamental nature of the businesses that we were discussing. It is not because of any other reason, because of liquidity or anything of that sort. We discussed the fundamental reasons that are responsible because those business models are good, the corporate governance is good, incentives are aligned, no corruption, very well run companies, efficient capital allocation with massive leverage, operating leverage coming from IP related business models, not manufacturing related business models, and global growth. You put all of this together, that is primarily responsible for the overperformance. So that has not changed. Whether you look at pre-COVID, you look at post-COVID, those factors still remain. And they are going to continue to remain. So unless those factors change, no matter what time frame you pick, the outperformance will remain the same. So that's why we are saying that you pick, I mean, there may be a period of 1 or 2 years or 6 months where, because of some reason, some countries may underperform, some stocks may underperform. And COVID was one such time because things were going crazy. But if you eliminate such special circumstances, outside of those special circumstances, I think in a normalized scenarios, these companies and these sectors are likely to keep outperforming because of the fundamental underlying businesses, the underlying nature of their uh, companies and management teams. So we are not worried about any particular time frame. No matter what time frame you pick, they will continue to outperform. That's our view. Go ahead. Next question, please.
Yeah, another question we have received is so most of the US investor invest in index funds. So if they are investing in large cap funds and their expense ratio could be very less. So our portfolio is quite similar. We are investing 90% into large cap. So how are we different with that large cap fund or let's say index funds?
So let's pick our index S&P 500, right? They invest in 500 companies, which means if you invest in that index fund, you will have JP Morgan Bank, you will have Citibank, you will have General Motors, you will have Ford Motors, you will have Coke, you will have Pepsi. Everything is a part of your portfolio. You don't see it because it is in an ETF, but if you were to look at those ETF holdings, you will have all these companies. You will have Caterpillar, you will have Nike, you will have, you name it, some of the worst manufacturing companies, some of the good manufacturing companies. You will have oil and gas companies, you will have Exxon Mobil, right? You will have all these stocks in your portfolio. What we are saying is that if you are an investor in an emerging market, high growth market like India, you should not, for banking, why do you want to invest in JP Morgan or a Citibank? You are better off investing in a HDFC Bank or a ICICI Bank or a Axis. I'm just giving examples. These are not stock recommendations. But the point is BFSI sector has much better credit growth in India. Why do you want to go to a low credit growth region like the US just for diversification and investing in the US? Why do you want to invest in a General Motors or a Ford Motors when your local companies like Maruti or Mahindra are much better? So if you invest in an index, that's what you are doing. You are investing in all these companies where you have better options in India. With us, we have decided, and I personally, when I was thinking about this, I thought about that. I don't want to go to the US and invest in a Citibank or a General Motors or a Ford Motors. I would want to eliminate all those stocks from my investment. And that's what we are doing in our portfolio. We eliminate all those stocks from our portfolio. We do not invest in such companies. We only invest in innovative and disruptive companies. And these companies are not available anywhere else in the world. So for that, if you're going to the US, it is fair. So just to give a very raw and a very non-financial stock market related example or a corollary to drive home this point, and this is a very important point and a very important question, so thanks for the question, is that if you are going to Amritsar, you should not be looking for a dosa, right? If you're living in, say, Chennai or Bangalore, and if you're going to Amritsar, and if you're looking, to get dosa, then that is the wrong place to look for a dosa. Dosa, when you're going to Amritsar, you want to look for chole puri, right? That's what you should look for. So similarly, when you're going to the US markets, don't look for BFSI investments. Look for something that is special over there. And that is the disruptive and innovative stocks. And that's why we focus on that. And so if you're going to invest in the US, we feel that you should invest only in these type of companies, which is the specialty of US. And that's why our portfolio is very different from those 500 stocks. Our portfolio is only about 20 to 25 stocks at any given time. And sometimes even less than 20. In the past, we have had 17, 18 stocks only. So, and we look for, like if you're going to Amritsar, we are looking for chole puri. We are not looking for dosa over there. That's the way you want to think of us. Go ahead. Next question, Sumit.
So from same attendee, we have received a query that can you show the trend of the portfolio returns while comparing with S&P 500. So if you can, show the returns on that
Yes,
slide.
yes. I do not feel we have a slide in this particular presentation, but we may have it. No, we definitely have it in our main presentation, and so we can share that with you. But rough years, BayFort Capital. Sharing. I think if you see over here, these are our returns. So if you see our 3-year returns um, and our since inception returns also, are you able to see the slides on your screen, Suman? The
Yes,
return.
sir, I'm able to.
Yes. So yeah, this clearly shows that 3 years since inception, fiscal year to date, 1 month, we are above the S&P 500. In the last 1 year, you will see we were slightly below the S&P 500, but we are a concentrated portfolio. So there could be short periods of time where our portfolio may be slightly underperform. So this clearly shows that our approach to investing in specialized stocks in the US is working, especially if you see all the other periods over the long term, also 3 years since inception annualized. So since inception is 3.5 years, then you have 3 years, you have fiscal year to date, you have 1 month, you have 1 year. So different periods we have shown over here, and we are fairly outperforming our index. Next question, Suman.
Sure, sir. Thank you. I think that gives us a good clarity about what the question was asked. One another question we receive very frequently is, let's say if any investor who have around 50, 60 lakhs and they are looking to invest in global equities. So is it good to invest like all together or either in a staggered manner? So what do you think?
Yeah, I would recommend, see, if you are first time investor in any class, equity class, or any sector, you probably want to start with something that is meaningful, not useless. So you don't want to start with 1% allocation of your portfolio. That is useless. You are wasting time, right? And then you have to follow it and all that. You want to give it at least 10 to 15% of allocation of your portfolio. So say if you have 1 crore, you want to invest at least 15 lakhs to start with. That will be meaningful because you think this is a good idea. If you think it's a bad idea, you should not invest, right? If you think it is a good idea, you should give it a meaningful allocation. If you're giving 15% allocation from your portfolio, that is meaningful, which means if you think it's a good idea, you will make enough money. Now, you may think it's a fantastic idea, but you may not want to start with 50% of your portfolio, right? But you can gradually increase. So if you start with, say, 15% of your portfolio, you can increase it to 20, 25, 30% slowly. But always start with a meaningful portion and then increase slowly. And that I'll let you decide. If you have a 1 crore portfolio, you have a 50 lakh portfolio, you have a 5 crore portfolio, whatever your portfolio is, start with at least 10, 15%. So make sure that you are convinced enough to start with 10, 15%. If you're putting 1%, that is useless. That you are not convinced about it, then why are you investing, right? It's a waste of time. So you start with 10, 15% allocation to an asset class. I'm not talking about single stocks. Single stocks, you have to be careful because the volatility could be very high. But I'm talking about an entire, say, you want to invest in international stocks. That's a totally new kind of a asset allocation for you. So start with 10, 15%, and then slowly overall, over a period of time, you can increase it to 30, 35%. And with international stocks, I think you can go up to 35%. Some of our peers, they recommend going all the way up to 50%. But in a well-balanced portfolio, you probably have home country about 60, 65%. And 35% in international. So that's the way I would look at it. Start with 10, 15% of your allocation and then gradually move up to 35%. Go ahead, next question.
So far, sir, we have received all this query. So in case if you want to add something before closing.
Perfect. No, nothing much to add. I think we discussed everything in lot of detail. Thank you very much for your time today. We will do this on the first Saturday of next month also. This first Saturday was a holiday weekend, so we did not have a webinar. Next month, the first Saturday of the month, we look forward to seeing you all again at 11 a.m. Thank you for your time and have a nice month. Thank you. Bye-bye.